Olivier Garçon, who is the Director General of DG FISMA, had intended to make these closing remarks, but unfortunately he cannot make it due to another last-minute commitment, so he has asked me to deputise for him at very short notice, which I guess is an occupational hazard when you're the Deputy Director General. Now, on the other hand, I very much welcome the opportunity to share some brief thoughts on what I think is one of the most important issues for the European Union today, and that is how to finance retirement income for the medium to long term. I think for someone who is my age and getting this close to retirement, I'm pretty okay, but I do worry about the people who are coming behind us. And more specifically, I would like to use the occasion to make some fairly general remarks on one of our key policy responses in this regard, which is the PEP, the Pan-European Personal Pension Product. That is assuming there's anything left of interest to say that Natalie hasn't already said as an expert. Now, Europe, I think, is facing a major demographic challenge. In 2008, there were 4 people of working age, that is between 50 and 64, for every one over 65. By 2060, that will be a 2-to-1 ratio. Now, I'm an economist by profession, and I know just how inaccurate demographic projections can be, but they're rarely that inaccurate. So I think we have a lot here to be worried about. And this development in EU demographics will have implications, I think, for almost every part of our economic life. It will require changes, I think, in how we organize economic production. It will require changes in the way we utilize labor supply. It will require changes in both the allocative and the distributive functions of our public finances. And it will also require changes in the way we organize our private finances. That is, in how much we spend and how much we save. And amid all these changes, the sharp increase in the dependency ratio implied by these demographic trends will more specifically intensify pressure on the provision of retirement income. And therefore, the key question, and I guess the question you were discussing coming in, was how to ensure that future pensioners will have an adequate disposable income. And by adequate, I mean not just in absolute terms, but I mean relative to the disposable income they will have enjoyed during their working lives. And the answer to this question, I think, lies fundamentally in parametric reform of the pension systems in the member states, and notably by aligning the retirement age with the increase in life expectancy. Clearly, if we are to live longer, I think it's not unreasonable to work a bit longer as perhaps the most powerful means to preserve the sustainability of our pension systems. Now, on the way in, I detected there's some skepticism around this. I think I might have liked to be in this panel. I think there's really no way out of this. This is the most powerful way to balance the sustainability of our pensions. But another key reform, I think, will be to enhance the opportunities to supplement public pensions by occupational and personal pensions. And in this context, the Commission, and more specifically DG FISMA, is working to provide individuals with safer and more accessible options for private pensions. Maybe just a couple of words on occupational pensions. I mean, their member states are now in the process of transposing the revised directive on institutions for occupational retirement provision. These new rules will strengthen governance, transparency of information, cross-border activities and transfers, and will foster long-term investment. This directive follows the 2014 directive on acquisition and preservation of supplementary pension rights, and it complements the work of the Commission in fostering pensions tracking systems such as the T-type pilot, which was recently conducted by our colleagues in DG Employment. But this afternoon, I want to focus more on efforts to promote personal pensions. Now, as part of the Capital Markets Union Action Plan, the Commission will adopt later this week, Thursday, a proposal for a pan-European pension product, the PEP. The objective of this proposal will be to provide high-quality, simple and transparent pension products. These products will be available across the EU and will be more portable across member states. The PEP will not only widen the choice for savers, but we believe will create larger funding pools for investment in the new single capital market. So why is the Commission undertaking this initiative now? While currently the European market for personal pensions is fragmented and very uneven across member states, only 67 million people from a total of 243 million between 25 and 59 currently subscribe on a voluntary basis to financial products with a long-term pension objective. And these 67 million are largely concentrated in about 4 member states: the Netherlands, the UK, Belgium and Spain. So we see from this starting point that personal pensions is an area of pretty strong potential within CMU, and the PEP is expected to help in unlocking that potential. Now, as is so often the case, the absence of a large and competitive EU personal pensions market can be at least partly traced to a patchwork of different rules and regulations at national level. If frictions between these different national rules and regulations can be eased, and note I'm not talking about full harmonization here, we're talking about easing frictions, we believe that there is scope for a larger and more dynamic market to emerge. And of course, in the specific context of this event, we are very conscious that consumer protection is a key consideration in creating an integrated market for these products, for any product that targets retail investors. I picked up a little bit of this when I was coming through the door. I think we have to find the right balance between providing investor choice and providing investor protection. And again, listening to the discussion at the very end, again, I might have liked to be in this discussion. This is not going to be easy, and it's not evident. I see, Mick, we have had this discussion over many, many years. I don't think we still agree, actually. But I think we have to find that balance, because, as has been said, if we overprotect, in a sense, we protect investors from choices they should have. On the other hand, we have to make sure that we do not expose them to risks that they do not understand or know how to manage. Now, I know that Finance Watch and consumer organisations are very keen on making sure that all retail financial products are safe and cost effective. Indeed, they have voiced these very concerns in our public consultation on the PEP. And in particular, they have highlighted risks associated with a lack of transparency and the high cost of certain existing pension products. In formulating the PEP proposal, and Natalie is heavily responsible for formulating the PEP proposal, we have tried to address these specific concerns and other concerns relating to investor protection. Now, I can't describe in too much detail the proposal which will be adopted on Thursday, because it has not yet been adopted by the College. And I'm going to leave it to my big boss, the Vice President, to formally present the proposal. So I'm not going to steal his thunder. On the other hand, as a little sneak preview, I want to mention 4 broad features of the PEP, which we believe will be of major benefit to savers. First, the PEP will complement existing pension products and schemes by providing more options for saving for retirement. To this end, the provision of these products will be open to a wide range of providers. Second, the PEP will contain a simple set of investment options, including a low-risk default option. Third, the proposal will ensure full disclosure of information in respect of the PEP. So before contracting, there will be a specific PEP key information document, and information provision will be assured over the duration of the contract. Information will be provided both electronically and in paper form. And then lastly, in these 4 points, switching from one provider to another will be facilitated as far as possible. And for those who move across borders, such as mobile workers or students studying for degrees, there will be the possibility to keep a personal pension plan in another member state without switching providers. From the provider's perspective, we believe there will be also incentives to enter the market, because there will be standardized core features, which will give benefits of scale economies, and of course there will also be the possibility to sell the products across the EU with one single authorization. Now, again, listening as I came in and picking up somewhat the tone, we see many benefits to the PEP, but we are not naive about the challenges in developing a European personal pensions market. Like many of the measures in the Capital Markets Action Plan, it's going to require the willingness of member states to address thorny issues in removing barriers to integration. I think I've already mentioned the need to balance investor choice and investor protection as one of those issues. And taxation is another one of those thorny issues, and I heard some questions to Natalie on the way in. I think tax treatment probably represents the biggest challenge when it comes to designing an EU-wide pension product. We see specific tax reliefs as key drivers for savers in buying personal pension products even today. And not surprising, the criteria for tax relief on these products differ widely across member states. Now, in this respect, the PEP proposal will remain as flexible as possible on these, what we would call tax-critical features, so that providers can adapt to national market specificities. But I nevertheless expect pretty interesting discussion with member state tax experts when this proposal is making its way through co-legislation. But here I want to repeat my kind of standard line when I talk about CMU. Capital Markets Union and the PEP will not be created in Brussels. It will be created by Brussels, but also by the member states and by the markets. And so if, as I'm so often encouraged to be ambitious in terms of Capital Markets Union, then member states, providers, and indeed consumer protection organizations will have to tackle difficult decisions. We simply cannot have high ambitions for Capital Markets Union and then not tackle the difficult issues. So at this stage, maybe I will stop on this and leave the rest for the Vice President on Thursday, so that you all go and listen to him, of course. I will simply conclude maybe by recalling that the PEP has been included as a flagship proposal in the second half of the CMU action plan, the so-called midterm review and second phase. This is not an accident. I mean, this reflects not only the importance we attach to the proposal, I think it also reflects this very dual vocation of the PEP in both expanding the choice for investors in pensions, but also in creating large pools of investable funds, which, if used appropriately, will deliver higher returns overall. So in this way, we believe that the PEP proposal also fits very well into the central theme of the Juncker Commission, which is the creation of jobs and growth. And so many thanks for your attention. Thank you.